All right. So for those guys that might watch this on recording, it's April 14th, 2015, and we brought back Woj. He's been on here a couple times before. Real briefly, Woj and I originally met the same prop firm we started. In fact, Woj, we started I started April 24th, 2000. You started like a week or a month later, right? April, May
Right.
2000. So that's how we met, and we traded equity futures. Woj eventually got with a prop firm that traded more spreads and treasury spreads. So we're not talking, this isn't a discussion on how to trade a spread. Just know that it fits under the umbrella of market relationships, intermarket correlations. That's what spread trading is. That's correlations front and center. So he might spread a cash treasury with a future to future. But again, we're not going to get into the mechanics of a spread, only what they might be telling us if we're trading equities, if we're trading individual stocks, if we're trading individual treasuries like the outright bond or outright note or Boone and things like that. So he came on, I think 6 months ago, and it was more just a kind of an interview I did with him. Last time, about a month and a half, he came on and is going to talk a lot about what we're going to talk about today, just going back and forth with kind of a helicopter view of the markets from the Treasury side. I got some questions for him. You guys got questions, you pop them in. I'll read them off to you, Woj. But what we were saying before we started, before I kicked the screens over to him, was over the weekend and last night or yesterday it started hitting some of the wires I look at here in mid-April. Greece and the EU negotiations with the repayment back to the IMF and some of these deadlines not being met. April 24th, there's a deadline, late April, and it's starting to create a little fear. And when you have fear that enters the market, you usually get strong bond prices and weak stock prices. And over the last couple days, we sold off into yesterday's close in the equities, kind of got weak today, and they grabbed a bid that Woj is going to show you right now. But Woj, thanks again for coming, man.
Yeah, no problem. The reason why I'm doing this is to help Anthony, grow a strong trading room, and hopefully some of you guys, become successful traders and you share what's working for yourselves. Because I'll be the first one to tell you, none of us have all the answers, and it's really a good thing that you guys are participating in rooms like this. So I don't really have anything specific. About 3 or 4 weeks ago, I've noticed a serious drag on volume. We're talking about a week before the FOMC. That's usually a lull in volume, and price order flow is really choppy. So leading up into the Fed was kind of garbage. Then Fed week is always kind of slow. Monday and Tuesday are really slow. Then you had the Fed, and it seemed like it drained all the volatility out of the continuing days or the following days after that. So now we're going into 2 weeks of low volatility, and the following week is, leading into a big holiday. You got Passover, you got Easter. That week was kind of slow, and I noticed that the spreads that I trade, so because if a spread is slow or a spread's range is slow, the outrights are going to be tight. So it's not like the spread prices are going to be, extremely rich or cheap versus, a 4 or 5 tick move in we'll just call it the 10-year. So it's all relative. And then after the holiday, that entire week, so this is last week, was probably the lowest volume week I've seen since in August. And August for the last 15 to 20 years has been an extremely slow month. So it's been really discouraging for a lot of guys, experienced, novice guys, you name it, guys that are clerking for other guys are experiencing, a lot of pain right now. And what do you do during that time is kind of like just a little thing that I want to talk about. What I do, I notice that, so those are the symptoms of the market that I just talked about. And then what have I noticed? How I'm trading? Because the ranges are tighter, I noticed that I can increase my size by twofold. And I didn't do that for the first 3 weeks of this, slow market. So let's say you're trading the S&Ps or an outright S&P and outright 10-year note. They're not going anywhere. We were shown the first week before the Fed that we're not moving. So what you used to take out of a move is not there anymore. So I don't know how you guys trade or whatnot, but the way trading for me is I can usually take about a tick or two out of the market, and that's a lot because it's a spread in treasuries. It would probably be like a 2-handle move or an 8-tick move in the S&Ps. Well, that, if you compare it to that, I'm getting half-tick moves or half-handle moves now in the S&P. It's just really bad. So finding spreads for myself that aren't blowing out, that are having a tight range, I should have increased my size and taken smaller moves out of it. But I'm fighting this doldrum, and I'm keeping the same small size on, and I'm looking for a bigger move. Well, I'm not getting either. So I'm ending up either losing money on the trade because I have so many different spreads on that I'm trying to attack the market in so many different ways, and I'm either scratching every position or losing a little bit. And by the third week of this this lull, I haven't made any money, and I'm actually down money now. And what I should have done was recognize, like, these markets aren't going anywhere, so find good spots to put positions on. And I had to increase my size and take a smaller position out of it. It sounds counterintuitive or like a risky thing to do, but if you notice what your markets are doing, it makes sense to take advantage of slow markets. But before I did that, and that was just in the last 4 or 5 days. This isn't something that I discovered and been banging it out for a long time now. Like I said, this is about a 4-week problem, and I just discovered what I could have done last week. So I noticed I was forcing trades that I didn't want to normally take because I wasn't getting the same kind of reaction out of the spreads that I was putting on. I was over trading in bad areas. You can look at a chart of many different things that you can even see if you just take a look at the S&Ps today. This move here, you can see it drops down, they open the S&Ps up, and they slam it down, and they rip it back up. I mean, I don't know how you guys trade that. I mean, I'll be honest with you. That's just the most ridiculous amount of price action I've ever seen. I did make some trades in the S&P, and I lost some money. I was buying in this area here. And is there any way to erase this? How do you erase that?
Right-click, and then it'll...
There you go. So I was buying against these lows, 2080, if you want to say it like that. So getting back to some of the things that I was doing wrong, I mean, I noticed everybody in the office is complaining. And that's not good for anybody. I'm complaining. The guy next to me is complaining. And he's been there for 6 months. What he's complaining about, I have no idea because he hasn't seen anything before. You know what I mean? Just keep yourself in check. And once I notice there's a pattern of, just a bunch of complaining, it's very cancerous, and it kind of takes you away from what you could do. And if there's nothing to do, get out of the office. Get away from your desk. Quit trading. And I had to do that a lot last week because it was so bad.
Well, you know what's interesting is that what people might not understand, some do, some might not, is bad trading for guys who know what they're doing is light volume, tight ranges. Great trading is huge volume and big ranges, just volatility. Volatility is opportunity for guys who know what they're doing. People who don't know what they're doing hate volatility because it's too much risk. They don't know how to read price, and they get killed. So what we want is movement. We don't care if it goes up or down, just move. So what we've always done, I know you've done this, Woj, and I do it, is if the markets are really moving and it's an event-driven move or whatever, and it's sustained over many days or weeks, you cut your size and increase your risk. because you're just going to have to take bigger losses because it's moving, but you're going to get bigger winners. So if your size is too big, you might not take some good trades. So you cut your size a little bit because your winners and losers will be bigger. But it's the opposite of when it's slow. What Woj is talking about is if you don't increase your size, then the little bit of profit you have isn't going to mean anything, and you end up leaving money on the table. And so it comes back and you scratch it or you take a small loss. Where if he had bigger size on, the money he had into the trade, he would have taken the profit when he had the profit into it. So it's the opposite of cutting your size when things are busy and increasing it when things are slow. It's a timing thing. It's hard to do either. It's probably easier to cut your size because things are moving and you're just clicking when it's busy. But the complaints happen, and this is cyclical, where it goes from busy to slow, slow to busy, back and forth. And I don't think it's a long period of being slow and light volume. It's just one of those small dips that you have. And you go into capital preservation mode by recognizing it so you don't give back your profits like most guys will do. But I think it's intriguing how you think of that. And I think your spread influence, Woj, surfaces to increase your size when it's slow. I think that's a great way to look at it.
Yeah, I would have had a much better last 4 weeks, knowing that the spreads have been tight for the last 6 months to begin with, or at least the spreads that I like my go-to spreads, they're tight to begin with, and they're usually giving me a decent profit with a lot less size than I'm trading right now. And I noticed I'm doing the exact same spreads, but the profits aren't there. I mean, it's not giving you a full tick, and a full tick, like I said, let's call it 8 quarter ticks in the S&P. So if you can take 2 handles out of the S&P on every trade, that's pretty good. If you can, define your entries and exits, that's a great trade. I'm getting a half tick now of profit in the S&Ps. Two ticks. It's garbage for us right now.
It's not worth taking. It's not worth taking the trade.
No, but you have to do something. I have to find a way to make money. So the same spreads that I normally do are making money. They're just giving me less opportunity. So, like I said, it is hard to increase. It's really easy to decrease your size because it's volatile. It's volatile. So you're probably finding 3 different ways to make up for 1 loss. But when it's slow, you can't afford to have 1 loss because you're just not going to find that there's not enough opportunity to make back that 1 bad trade.
What I've gotten good at, blow up your S&P chart if you don't mind. You got to get out of the pen. Just right-click, hit erase all. It'll bring you to a cursor. All right, so this is the S&P on a 15 or 30-minute.
You want me to change the
interval? No, that's fine. What I've gotten good at, and I was able to explain it. You know how you do something and you might not think of it, and then you might not know how to explain it, and then it clicks. And that's what helping people helps by teaching your learning type of thing. It's where it's helped me a great deal. I have gotten good, especially in a market that is a whipsaw market like the S&P, because it has a lot of retail influence. It's got 500 stocks that make it up. And I explained it last week, and I had a good class last week, is transitional moments. When the bulls say, uh-oh, when the bears say, uh-oh, who has the leash? Where's that turn? Today, I read it a lot better than I traded it, because it was if you look at, we're weak, we should open up and go straight down. We open up and go straight up, and then they go down. And it was like, you got to be kidding me.
Sorry.
That's all right. And it was like, you got to be kidding me how we can't open up and go down. That's fine, we go up. But there was a moment where it turned off the 90 evens, sold them back down to like 75 half. It was a moment that was probably the low, rejected low, and they were going to run it back up, and they eventually did. There's a lot of movement in there. Well, what you think about that? It's about a 15-point, 5-point rally, 15-point sell-off, 15-point rally.
It's a lot, right?
It looks it looks like a whipsaw, but you see the range, and you could be like, man, this is very tradable, and it is.
Opportunity in there.
It was easier to read than it was to trade. There was no doubt about it. And that's what I've gotten good at is those transitional moments where you're going to get rejected prices off the turns, and you got the bulls too greedy, and now they're the ones that got to liquidate it, and they sell it. They end up selling it off to 75.50 or whatever. But there's a lot of whipsaw jerks as I look through this chart. It's a 30-minute bar chart, and it just doesn't. What I got up and read this morning, though, and this is what you and I were talking about at the beginning, was Greece coming back in, and you were talking about Financial Times had an article. Could you go back to that?
Yeah. So yesterday, let's just pull up the 5-year. Now, let me move this. At this point right here in the 5-year is when Rand Squawk and Trade the News discovered an article that was published by the Financial Times talking about if Greece and the Troika can't come to terms on, for them to get more money, they're going to default. I mean, it's the most ludicrous thing that's going on over there. I mean, they need to get more money in bailout terms, otherwise they're going to default. So, they just need to get thrown out of the euro, but it would be bad for us, in my opinion.
That was what was that?
At that point in time, you can see in the 5-year we were selling off pretty good. That's a pretty big move down in the 5-year for a Sunday night, Monday morning, and at 7 o'clock. I mean, like clockwork, it was so thin. See, that's another thing you guys got to realize. It's thin in there. I'm watching the S&P sometimes, and I'm thinking, God, it's 90 up. It's 75 up. I mean, it used to be thousands.
Yeah. It's funny.
So,
it's funny you bring that up. I was watching. I don't mean to interrupt your train of thought, but I was watching.
Okay.
I was watching a recording of a guy doing a dome exercise, and it was like 2 years ago, and it was during the day session. It was 1,500 up every price, and then it would go to the best. The offer would roll bid, and the next offer would be 3,000, but then it would be sliced to 1,500. Now 1,500 might not trade there, but it was before all the anti-spoofing regulations came in, and every bid offer was 2,000, 1,500 to 2,000 up. So it's been a little easier to read the book, okay? And it's about those moments. I've done something that, I wish back in the day it would have helped us to do this for newer traders, Woj, and then for us reading the book is clips of what to look for, what to anticipate. So if you had like a few instances. What I've done is I've recorded a few instances of a lien, right? How to lien on a certain offer or bid, and then when it gets taken out, but show it as it happened. So now you know what to anticipate as someone who's looking at the book and having no idea, just a bunch of numbers on this book, right? But then to see a recording of it, and I call it like a trading file cabinet. There's just files of these clips of instant order flow instances of a minute or two of what to look for. Whether it's a lien, a big buyer keep coming in, he's lifting offers and bidding behind it, it just it's helped a lot of people know what they're supposed to look for, right?
Right.
It's really cool stuff, and I mean, it's done a lot for people who have it's hard to explain to someone, oh, did you see that? They have to see it. They got to rewind it. They got to see it again. They got to see it again. And then a huge exercise is write down the instances you've seen. You've seen when these buyers came in or when they took out an offer and they ran it and that was your best location to get long or whatever. But going back to Greece, right? So was this Monday, overnight Sunday into Monday?
This is Monday morning. That little circle I indicated is Monday morning at 7 p.m. or 7 a.m.
Our time.
Our time.
All right. And so that put a risk bid into treasuries. And I noticed the Bund, we had negative yields or something in the Bund. They really...
The Bund's like 0.15 right now.
It's a 10-year expiration.
Is 15 basis points.
That's, you're almost paying someone to keep your money.
Right.
That's a joke. So all the treasuries grab a bid because everybody flies to safety. It's a flight to safety type of trade, and usually that puts pressure on equities. Now it has. DAX Euro stocks were off. Do you have a Euro stocks chart?
Yeah,
You gotta right click out of it.
I have the yeah
First
the
market you ever
DAX.
traded was the FTSE, wasn't
Here's the DAX. It's the same thing as the Euro stocks.
it? Yeah, so FTSE was the first market you ever traded, wasn't it?
The FTSE,
It
and
was
then
strange.
we went in. Then you and I traded the Euro stocks and the DAX,
Yep.
and then after 9/11, that dried up, and we started trading
Well,
treasuries.
you
We started
yeah,
trading.
you went to the bonds first, and then I got in. I should have made the move sooner, and you probably say the same thing about yourself. That was a moment of opportunity, recognizing it and making the shift as soon as you can of a market moving. Because stop. Remember that Eurex changed the way they reported data in the Euro stocks first, and it was buckets of.
That's
Remember that?
right. I remember that. Wow, I haven't thought about that in a long time.
Yeah, and they don't do that anymore, but it was just a way to save on, well, whatever it was. They did it in equities first, and then they tried to do it in the financials. But the bonds then rolled. See, the Board of Trade and the Merc then made a push to go electronic in like after 9/11 in 2002. And we were trading. I remember you were trading bonds in the afternoon because I would leave and you would still be trading. And I said, what are you staying? What are you trading? He said, I'm trading, you're trading the bonds. And you were able to make 150 ticks in the afternoon. So
Right.
I started sticking around and it felt like it was working overtime when you stayed in the office till 2. It felt like 8 p.m. at night back then because we were used to leaving early morning or late morning. Um, but anyhow, getting back to the DAX, this is what, a 30-minute? Yeah.
Yeah.
So even though they're weak on today's session, they're still they're stronger than you would think if someone told you Sunday night, Woj, that on Tuesday the treasuries are going to be that high. You would think that the equities would be a lot lower, right?
This is the move yesterday at 7 o'clock. So they sold off as well.
Would you think that they should be weaker?
No, because there's two things that are going on. Well, there's one thing, and that's the ECB's buying everything. Um, and it's not the equities per se, but because you don't have savings and you like investors, pension funds, REITs, they need to put their money someplace, right? So they're not getting their money in yield anymore. But they know they're trading the bond as a commodity right now. They're not buying it to get a coupon anymore. They're trading it because they know price is going to go higher. So they're willing to take the negative yield in lieu of a greater price fluctuation. So they're buying bonds right now, no matter what happens, and because they're looking for some place to park their money outside of the bond, they're going to buy equities. So even on down days, just like the S&Ps of the last 3 or 4 years, we've seen the equities go up every day, except on certain days. I mean, you can count the days, taper and that October move. But getting back to investors are going to put their money into equities and the boom. Now, where's the best place to put your money? The safest place, U.S. Treasuries. So you don't see a big move in the boom and bobble compared to let's say, the U.S. 10-year, because the U.S. 10-year has so much more upside to go, considering if you're a European investor, where are you going to park your money? You're either going to take a lot of risk and put it in equities or some kind of real estate, or you can go into the U.S. Treasuries and try and trade with a coupon, and you're going to probably get prices to go up. So it's a two-part, it's a double win. So if people are looking at the U.S. Treasuries and saying, well, yeah, This is a European problem, and Greece is going to default. So why isn't, if you buy Boone or if you buy Gilts, if you buy short sterling, and you say how come it's not going up as much as the 5-year or the 10-year in the United States? Well, it's because we have so much more upside to go. I mean, we're talking, 75 basis points, 150 basis points in a 5-year. That's a pretty big range, versus the bobble is negative yield right now. I mean, you're losing money if you borrow money.
So the flight to safety, you're better in U.S. because you're actually not only got more upside in price, but you've got a
You're
yield
getting, yeah,
to
exactly.
realize.
So let's take a look at. You can look at the Boone. This is an overlay of the Boone and the bobble. And if I just go to yesterday.
Now, just for these guys, the Boone's a 10-year expiration, the Bobble's a 5-year.
So the Boone did make a pretty good run. I didn't think it was this good, but you can see it didn't even take out its prior day's highs. I mean, that to me is a failed auction, and what I mean by auction is price discovery. I don't mean the ECB issuing bonds. I mean they're trying to get prices above
All those swings.
right, all these prior swings from the 9th, the 10th. And when it doesn't do that, that's pretty crummy if you ask me. And you can see it actually retraces about 50% of the move right here. Where in the 5-year and the 10-year, yesterday, why isn't this shrinking? Here's a 10-year note, U.S. 10-year note. It retraces about 50%, and let me draft this. You get a pretty decent pullback here, right there. One bar over, you get a low, and then it's off to the races again. I mean, that just shows some pretty good strength versus European treasuries.
So while in a normal environment you get asset allocation, we do have weak stocks. The reason why it is not lower is because there isn't a lot of places to put. It's almost like.
Have you guys heard of the term reaching for yields or searching for yields? That's what it means. They're, investment firms, mutual funds, hedge funds, REITs, pension funds, governments. They're looking for some place to, park their money out of savings because they're actually losing money because of inflation. They need to put their money someplace, and it's not like your $100,000 IRA or $1 million. I mean, we're talking hundreds of millions of dollars here that are being traded every day and invested every day. So that's why you hear people are searching for places to park their money.
So they're willing to take the risk.
They have to.
Yeah.
They have to.
That's a good phrase. Reaching for yields, and you're trying to get a yield out of a stock index that you otherwise would stay away from if yields were somewhat normal or attractive.
Everybody out there knows that the equity market is a bubble right now, but you can't pull your money out of it. And I'm like, again, I'm not saying guys like us in this room here talking about the big pension funds,
The billions of dollars.
Yeah, the $100 billion hedge funds. I mean, they can't afford not to be in the stock market right now.
And that's that's an interesting way you said it was, and that's why these meetings are really good even for me, because there's always something you pull from it, and that is it's been irrational how strong the equity market is. But
it's obscene.
Yeah, but the rationale is what you just talked about is searching
and that
for
makes
yield.
sense now. If you segregate it that way, they could probably go higher. I mean, in all honesty,
Right, right. And
absolutely no reason. I mean,
the upside for guys that we're always learning. You would agree to this, Woj, but I'll ask you anyways. Have you ever stopped learning?
no, and that's why I'm doing these rooms. I mean,
Yeah.
like I said at the beginning of it, hopefully if I show a couple guys that actually break out and they're successful, a year from now we're still doing this, and a guy's like, I'm not trading this right now because it's slow. I'm not having any success in the S&Ps, but I'm trading, I'm trading lumber or gilts. I mean, I don't care what anybody trades. Find something that's there's a pattern and you're successful with it.
Right, and these principles apply to everything. It's just price
They
discovery.
do, absolutely.
It's just a breakout spread or outright lumber or stock indexes. What was
Yeah,
I
and
going to
keep
say though? That was the whole point of never stop. Oh, when you get into
never stop learning.
yeah, right. So when you get into um, the the fighting of a particular like a macro opinion and you're fighting it because you think this has got, this sell-off has to sustain. But then someone interjects some rationale like you just did. It goes back to saying the market doesn't have to do anything. It doesn't have to go down even if it's a bubble and ready to pop. Because every time it looks like the bubble's popped, these guys come right back and they make all-time new highs. Now, here's the silver lining for people learning. When I say never stop learning, there are some people in this room that have been learning for the right way for a while. See, the difference between you and I, Woj, is that many people didn't have the benefit of starting the right way the first way, where we were dropped in a bunch with a bunch of professionals on the floor and then a bunch of professionals in the prop group, right? A lot of guys, unfortunately, have to do an online search, and who knows which way they go first. They learn a lot about moving averages and Fibonacci, and that's it, or some indicators, just some abstract way to discover and predict price. They never get into, most people, correlations, order flow, head fakes, taking leans out. I mean, things that we learned day one, week one, month one. It might, if they ever have enough time on their journey, not going to be the first thing most of them learn, right? So the silver lining is when it's slow, it's a little easier to learn because things are slow, price action's slow. And then when it speeds up, you'll be able to slow down that price action because you know the right techniques and the right fundamentals, the right principles of what to look for. So the silver lining, I guess, is what I'm trying to say of a slower market is there'll still be days where it moves, but it's a good environment to learn because the process is slowed down.
Hey, I got to do something here. You can keep talking. I just got to update my settles.
All right, go
Yeah,
ahead. I'm gonna
yeah.
I'm
Go
gonna
ahead. Keep talking. It's fine. I don't. I'm right here. I just got to do this real quick.
all right. I'm gonna read a couple questions, but let me read through them first, and then I'll ask you. Tell me when you're done with that.
No, go ahead.
Zane asks, and I can answer this, but maybe you can't too. When he talks, what does he mean with a coupon? Same thing as a bill, a note, right? A bond. It's just you buy something.
A
And you're
coupon
giving
is the interest rate that a 10-year note or any kind of treasury note will pay you in interest.
Yeah. So a bill, a note, a bond, they're all the same thing. They have different expirations.
Yeah, when your grandma, gave you a $100 bond, you got interest for I don't know how many, like probably until you're 18. You know what I'm saying?
Right.
And you got a coupon. I don't depends on how it was structured, but you either got it, quarterly, half a year, or a year, and that's what treasuries are about. I mean, it's about governments buying our bonds, giving our government debt so they can get an interest rate. They're getting a safe interest rate. They can't go to China can't go to Bank of America and park their money, I don't know, what do they got, $2 trillion worth of our bonds, and maybe $1 trillion, maybe it's 900 something billion, and expect to move that kind of money in and out of a savings account or a money market account. So for safety purposes, they park it in other nations' sovereign treasury markets. They do it in Germany, they do it in Switzerland, they do it in Japan. They spread it around, but the idea is that their money is going to be safe overnight, and they're going to get a coupon for it.
They're going to get
It's
it.
called repo.
Yeah, they're going to get a return of their investment. See, everything is based on a return. It's what extends credit. Um, Everything runs on credit. That's why '07 and '08 was so catastrophic. And when I would tell people, Woj, you could relate to this, we were trading 9/11, and we traded '07 and '08. In September and October of '08 were like 9/11s every day. And it's great for market action and guys like us. And when I would tell, just a layperson who whoever it might be, a brother or sister, or say, this isn't good. Well, yeah, how's that going to affect us? I said, I'll tell you how it affects you. Go to the gas station, there's no gas. Go to the grocery store, there's no food. Because everything runs on credit. Everything runs on, I'll give it to you now, pay me later with a little interest. It's how everything grows. It's how people afford homes. And there's an overnight process of where money is parked to keep safe. And sure, I want some money I'll give you money, but I want some money for you holding it, plus the safety. And those yields have become so small that equities have become a place to say, usually it's a risky investment, so if I want a big return with big risk, I'll go into stocks or stock indexes. Now they're going into it for, correct me if I'm wrong, Woj, for a lack of anywhere else to go. And it's created a bubble.
Right, the whole thing's a bubble. Everywhere you look right now, it used to be just a real estate bubble. Now I think there could be problems all over. Right now, which you guys might not heard the lingo a lot, maybe, but read up on it. It's called the reverse repo market, and it has to do with the way banks lend to each other overnight. And the reverse repo market is the way the Fed is going to hike interest rates. I mean, I hope sometime this year, please. But that's going to come into a lot of discussions. And you can go on Bloomberg's free homepage, Investopedia. You can even go on Khan Academy and, just get a little bit more color on, or actually learn about what a repo market is and what banks are actually doing in overnight lending with each other and how that's facilitated, because the money market desks, or what I call our dealers, they're being pushed out. The banks, the dealers are getting squeezed out of being a middleman, and so the banks that really want to lend, like if you're a hedge fund and you want to park $2 billion into a savings account because and then there's a collateral transaction. So if somebody gives money, somebody gives cash, and the other party gives collateral, and that's usually treasuries. So there's no way to facilitate that right now, and it's becoming a problem for credit, easy overnight credit, and that's a really big thing for the financial markets, and I mean everything. S&Ps will have a very big impact on that as well. So get to know that a little bit. I think you'll be ahead of the game if you know what the heck they're talking about.
Is this how to unwind easy money from central banks?
Well, yeah, exactly. Well, two things. The Dodd-Frank Act are now squeezing out banks from facilitating this kind of a market. So you have three parties. You have the facilitator, which is Bank of America, let's say. Then you have, let's say, an investment company like PIMCO. And then you have Fidelity Mutual. And Fidelity has a bunch of bonds. They don't need the collateral. They want cash because PIMCO needs the bonds they need the collateral to buy something else. It's a very lubed system, and they're kicking Bank of America, the middleman, from facilitating this.
Ah, okay.
And they don't know what they're going to do right now. They think the Fed might be the fulcrum here, but nobody really knows. This is uncharted water.
So that big regulatory package, that's what the Dodd-Frank was, is just a giant regulatory bill. Yeah, and it's from the lack of trust in banks. So they went to Bank of America. We don't trust you to do this anymore, right? and that's when they cut them.
Right. So they cut the legs off of all banks, and now the banks are dead in the water, and you have no idea what kind of um, they did a lot of business, and the liquidity now in the treasuries and even the S&Ps is drying up because the banks can't have proprietary trading desks anymore. Now you might want to think that all they did was make money. You probably read like Goldman Sachs and Bank of America made money every day. Like they had one losing day. Who cares? What that did for us was it greased the wheels of trading. And I'm seeing it right now where it looks like volumes is drying up, and I hope that CME and a bunch of lobbyists get this Dodd-Frank Act at least somewhat overturned. Sure, they can't trade $2 trillion worth of credit default swaps, but I mean that's a different asset class than trading treasuries and S&Ps.
Well, I think a lot of these guys have taken out the risk taker, whether it's those prop desks at Goldman or these big banks, and they flushed out a lot of risk takers, and they're trying, and I think this is not coincidental, but the CME, Woj, for the first time in a decade and a half, is marketing to the retail audience futures. What is a future? And they've done a really nice job of it.
Are they going to stop the high frequency stuff? Because that's what's...
Yes. Well, I think they see that handwriting on the wall. What you just discussed is drying up liquidity and volume, and they're going to bring in a new batch of liquidity, which is the uneducated batch, which is they don't care who trades it. The CME doesn't care who trades. What you want are real risk takers. And if you know what you're doing, you want risk takers who don't know what they're doing. And that's who the Merc is marketing to. It's not like they've been doing this for 15 years. They never, ever educated the masses about futures. Forex does a good job educating to the retail audience. Individual stocks do an okay job with these big brokers, but the Merc never has done a good job. Eurex, think about Eurex. Well, who trades Eurex? Nobody, unless they're a pro. There's not a lot of retail traders in Eurex. Period. Every Eurex trader is someone like you or me. Typically, it's only been a professional prop type of exchange, outside of all the other influence it would have, because these exchanges never had to mass market to a retail audience. They are now, and I think that makes the future look brighter.
I noticed that even in treasuries, if they have some pretty good write-ups in their education section about what a bond is and how it lubricates the fabric of our society, to be honest.
Well, right, they educate what the product is, but it all comes back down. We're trading price, we're trading numbers. I don't care if the product, and you kind of mentioned it.
Well, it explains why that price is there right now.
Everybody should have another dimension of what the price is, like crude oil. What does this mean? Or a bond up in price means down in yield. You kind of understand that logistic. It all comes back though to predicting how do I buy it lower than I sell it, and then going from there. But point I'm making is that I'd rather have the retail audience risk taking, or as the risk takers that we trade against, than Goldman's prop desk.
Absolutely, you can't compete against.
No. They've got more information.
But you want those guys there to provide the liquidity. I mean, not everybody is the same way. Goldman, Merrill, they're not the same direction all the time. Yeah. So that's why you saw those big battles sometimes.
Right.
Because they had, 20,000 to do. I mean, that's opportunity. If they're gone, I mean,
And I seen high frequency let up. The spoofing, I think, got rid of some, because that was part of a high frequency technique, right? To put in orders, pull them in, and then catch turns and stuff like that. So the Merc is doing the job. If they were always doing this, I wouldn't have looked at it. But this is the first time they've ever done it since they become a public company, and they're doing it well. They really got good videos. They got a whole website, Futures Institute. It's a cool website about.
What do they have on there? About
Yeah,
everything or
it's
what?
cool. They have different exercise, like learn by trading is their motto.
What's it called?
Futures Institute. Com. When you
Hmm.
went to the CMEgroup.com, it used to take you right there when they launched it, but now you have to go futuresinstitute.com, I think is the
All right.
address. They actually got, I don't want to roll it out now. I want to wait till we create some small groups. There's a game within a game you could play in this exercise the CME did. And I screwed it up. I screwed up a recording. I had my two sons, they're 10 and 8 years old, play this trading game that is on the Futures Institute. And I had my one son was the broker. He was filling the orders. My other son would, well, the game was, and you guys will look at it, when we do the small groups thing, we could actually have, they're teachable and learnable moments, but my 10-year-old son, the lady would say something that was newsworthy, that was either going to rally or break the price of lumber, right? So she would come on and say the strike is over or whatever, and that would predict where, that would be the way to predict price was going to go up or down, what she was saying. So my older son, he figured out that I would listen to what she was saying and then make the trade, where he figured out that when she said something bullish, it would be a green arrow that at the bottom, and then you could buy it. It's like the simplest things are like the why didn't I think of that moment? So he was able to buy it quicker than I could. But the whole point was is I made my younger son the broker, and he would tell him what to do. Buy it. Because I just taught him real quick, after you buy something, you have to sell it. Because it only lets you buy up to 10 contracts. Well, I screwed it up. I had them recorded. I recorded their banter. And it was the same banter you would have heard on the floor between a broker and a clerk. I mean, without the language, obviously. But him yelling at, my one son yelling at the other one for not buying or not selling. Hurry up, sell it, sell it. And it was funny. But I never were able. The whole point is the edge in this job is the why didn't I think of those or that moment. The shake-up now, so now you're in capital preservation mode. Are you going to increase your size?
Oh yeah, I did it. Yes, I did it Thursday, and it's been very successful.
Right now you
The
just wish you
last
did it
few
earlier.
days, huh?
You just wish you had done it earlier.
I wish I would have done it. Yeah, I saw it and I fought it instead of adapting and saying, they're only giving me a half tick. Take the half tick. If you have, 500 tenure on, and that's a spread, obviously. I mean, you can make good money on that.
You're
Instead, I'm fighting for a tick or a tick and a half, and it's almost like trading's a lot like golf. Um, you can do it your whole life, and as soon as you master one part of your game, another part of your game falls apart. You might be able to drive down the fairway really well and practice on the tee all the time, and your coach just strutting you. The next thing you know, your putting's gone shit, or your chipping's gone. So then you go work on your putting and your chipping, and then your driving starts to lag. So that's how I associate trading to it.
yeah. There's
I mean, I should have picked up on this weeks ago and increased my size then and stop fighting the market.
Brad. I think we answered that. Yeah, he just recent discussion. Okay, good. So you guys pop in your questions if you have them, and then we'll give them a couple minutes and then kind of wrap things up. The asset allocation is opposite stocks and bonds. They sell bonds and buy stocks. The reason why that's coming in and out of vogue is because of what we discussed. Right, Woj? I mean, that's the...
Well, the problem right now is they're buying everything.
Yeah.
They're not selling anything. And that's why you're getting distorted ancillary readings. So when you get that, when something isn't working, if you're looking at cross products, which is treasury market to an equity market, right now they've broken down. If anybody's trading S&Ps off the 10-year, a big move in the 10-year or vice versa, if you're trading 10-year notes off of, you see a big move in the S&Ps, forget it. Don't even put it on your screen. The only thing that I can kind of see that's working is the dollar. So if you're trading a U.S. product, the dollar is really important. If you're trading European markets, obviously either the pound or the euro is important. But I noticed, hang on, I've noticed some big moves turn off of a dollar move. This morning, the dollar sold off. You had the yen and the euro spike higher. You can see it on my screen. I'll highlight it. And that really kept us going right here in both of these products.
Yeah, we were watching that. We were watching the yen. So that was facilitating some selling in the S&Ps. There's only moments. We'll talk more about
that came off of retail sales. The dollar sold off because of retail sales at 7:30 this morning.
We talked more about the bonds when there's that exact event of fear. Like Greece typically will rally bonds and sell stocks almost I don't want to say 100% of the time, but there was a comment that came out of the EU around 10:15 Central Time that was bearish for stocks, and they broke about, I don't know, 3 or 4 handles, and it was a clean move. But that staying with that ancillary or that correlation, you can't be married to it. I like your idea of the dollar, though. The dollar has given like the
dollar is a good indicator for the S&P and for the treasuries right now. That's the only thing I can tell. I mean, I don't see it. I can't trade off of the boon or the bobble, which Anthony said that's the 5-year and the 10-year over there in Germany. It's the biggest bond market in Europe. So if you're going to look at anything overnight or something like that, and I do trade overnight, so that is important. But like I said, I noticed that we were rallying still. We traded through yesterday's highs in the 5-year and the 10-year, and when the boon and bobble opened up this morning at 1 a.m. Chicago time, they didn't continue their up move, and it was a clear indicator for me to kind of get short. I don't like trading off of those, but I do like seeing when something should happen and it doesn't. Go ahead and take a shot during the day or during the night. For me, if the boon and bobble make a move to the upside or downside, there's not a chance that I'm putting a trade on because of that. Where you used to be able to collect a few ticks from picking the 10-year off of a boon or a bobble move, and that's probably what you guys can do if you see a big move in the treasuries. Okay, sell the S&Ps. It's not happening. Look for the opposite. I highly recommend if you see a big move, like up move in the 5-year, 10-year, or bonds, look for the S&P to sell off a little bit and stall. And if your indicators that you guys created with market delta line up, fade that. It's got to be a layup.
Yeah, where they just don't break as much as they should, and you got everyone stuck short.
Right. You want to pick the guys off there like, oh, the bonds are moving higher, let's sell it, and it doesn't go down.
Yeah.
You got them by the the hairs.
And the dollar would, in that environment, be what? Would be
the dollar is opposite of the dollar should be the opposite move of the a treasury, because it's devaluing or increasing the value of the underlying price. You have the dollar strong like it is right now, well then you have more dollars in the to buy stocks, so they should be lower. S&P should be lower because of a strong dollar, and that's not the case. They're just buying everything. It's the craziest market I've ever seen.
I think it goes to this next point. Juan asks, people are still talking about what happened in the Treasury complex in December of last year, and it seems if everybody is scared to be short bonds, even though rates are on historic lows. At these rates, the new normal, or do you think it is safe to assume that at some point bonds should set up for the short side? Are bigger institutions already starting to position for this? How do they hedge? Do they sell 10 years versus a 30-year spread? Do you follow what he's saying, Woj?
Yeah, sure. It's a real it's a deep and complicated answer. Um, in a nutshell, if they're going to raise rates, the short end is going to get hit the hardest. Now, the problem with the long end is what happened in '04 when Greenspan started hiking rates. The long end didn't go down; it actually stayed the same and went up. So you had the 2-year, the 3-year, the 5-year all selling off, and the bonds actually catching a bid. Well, what happened? That attracted very low interest rates in mortgages, and that created an asset bubble. So what's Yellen saying about this time around? This rate hike, this rate cycle that she's going to put us through, she deliberately said that if the bond market, the long end of the Treasury curve, does not go down when we start hiking rates, she's going to be really disappointed. In my mind, there's only one thing for her to do, and that's to sell bonds. I mean, she's got an arsenal. She has an inventory. The Fed has billions of dollars worth of bonds. She's got a ton to do. The conundrum in December, I really don't remember what was going on back then. It's just oh, I remember what was going on. It was the first time that Draghi said that they were going to do a bazooka of QE in Europe. And when you take a look at the Bund and the bond spread, Bund and the 10-year spread, it was very, very wide. If they're going to be buying the Bund, people are going to say, okay, this is no longer the Bund is too rich. So where are they going to go? They're going to go to the 10-year. And that's what drafted the entire Treasury curve up.
When she starts, when they do the rate liftoff, she's going to want
Everything has to go down.
right. She's going to want the long end to go down. If not, they're gonna sell into
I
it.
hope it doesn't go down. I want them to tattoo the 30-year. I mean, I really do. That'll create such good volatility for everybody.
Yeah.
I don't want it to be a slow drift lower. You know, I don't want that. I want it very.
You don't want to see a grind like you get in these just drifty type markets. Do you?
Right.
What are you looking at? You'd rather see a sooner rather than later Fed for volatility's sake.
Yeah, I would love for them to come out. I don't know if they meet next
2
month.
weeks.
In 2 weeks. Yeah, I'd love for them to hike rates in 2 weeks then.
Yeah, that would be.
But that can't happen. I mean, there's too many geopolitical problems out there. And the U.S. economy isn't that healthy.
No.
I mean, you just had retail sales below average.
Right. And you got payroll number. Well, the thing is you got payrolls that come off and they miss, and you got Europe and their central bank opposite of ours. You know, they're in an easing cycle, introducing QE. We ended ours 6-8 months ago and are ready to raise rates. So there is a lot of just a kind of a grind, and we want to see what's supposed to happen not happen. We want to see the bigger players to say, screw it, we got to do this or do that and be done.
Yeah, this should be a really good time for us to be trading. I mean, if Europe is easing and we're going to hike, I mean, that should create a lot of nice volatility for us, and it's not. And I don't know what it's going to take. But I figured this would have been a great time to be trading in our careers.
Well, I think it'll shake up and become that. I think it's a log jam and then pull it. I remember Scott that became the CEO. What is that company? Is that a prop firm that Dante's working at?
Talking about Dante's
Yeah.
group? it's a division of a hedge fund. FC Stone, they bought the Hanley Group out.
But they're just that division is just short.
They're a carved out niche group of a pretty big hedge fund.
But they're shorter term guys like us, everyday
Right.
guys, and he manages their risk just like he did for us, pretty much.
Yeah.
And then Scott, did he bring Scott in?
He did.
And then Scott had a great marriage between a great understanding of economic events that was a lot deeper than my knowledge and a lot of the guys' knowledge. But then he also had a good understanding of trading it short term, medium term, what is happening, what should happen, understanding those relationships. So he's like a good candidate to go right up and be a COO of a company like that. I don't know if Dante was too happy. He probably passed him up, but I don't know the whole situation there. You know who else is pretty sharp is the other Scott in Tennessee. I don't want to mention last names, but Scott K.
Oh.
It's no big deal either way. But is he? Have you heard about him lately?
No. I really if we haven't talked to anybody in the last couple of years, then it's kind of like out of sight, out of mind.
Right. Well, he was just the reason I bring him up is he was both Scott's.
He was good at what he
They
did.
were right. Extremely organized guy, but he knew the market as a trader and an economist, and that's a pretty unique blend. But boy, he would have a really. He didn't over review, but he would have a chart printed out, and he would have just. He would do the right kind of homework, not too much, but he would always get better. He was a guy that always got better at what he was doing, you know. Oh,
Yeah, some guys will get paralysis by analysis.
yeah, where he didn't because he didn't do too much
Yeah.
of it. He did the right kind of analysis, I guess is the point.
Well, he was aggressive. You got to be aggressive, and then he took the approach of actually learning what he was trading. And there's two sides of that coin, if you ask me. I've noticed some of the guys that I know, they don't have a clue. What a coupon is. Like one of your guys asked for a coupon, and he's been trading treasuries for 10 years. He doesn't care about anything. He just trades the trade. And where I might slow myself down from a trade because, let's say, the Greece situation was starting to heat up, where he didn't care. He's doing the exact same thing he did last week when there was no hype about it. And, yeah, he might get run over one day where the next day he does the exact same thing he did 2 weeks ago, and he's right back in the pocket, and he's doing really well. Where I'm, frigid to put this trade on because it's very,
Right.
There's certain things in the treasury market that will move certain ways based on credit risk and stuff like that. So I'll avoid that trade, and he's putting it on. I'm thinking, you're an idiot. And the next thing he's making, a lot of money.
Well, it's what I try to convey, and I didn't think about this until about, I don't know, inside a year ago, where the knowledge that you're supposed to have is the same, but to think you're going to trade exactly like someone else is insane. You got to find your groove and go with it. But you have to have the foundational principles of what we're talking about here.
That's what I teach all of my guys. I'm pretty hands-on with my guys, but on the same hand, I'll never tell them what they can't do. They got to figure that out on their own. I would never want somebody to tell me I can't do something. Oh, that trade's terrible. Don't put that on. What if, a really risky trade is a FOB spread, 5-year against bonds. The reason why it's risky is because of all the duration in between a 5-year and a 30-year. You don't know where a 30-year is going to be at in 30 years, but you got a kind of an idea where rates are going to be at in 5 years. So that's why it's a pretty dynamic spread. And on an intraday level or intraday basis, the thing moves quite a bit. And, there's certain guys that just know how to pick that spread apart, where me, on the other hand, I would never touch that based on just being rich or cheap,
No, but I like what you said. don't tell someone they can't do it. Maybe they can. Who are you to say that? As long as they
Exactly.
have the tools, let them turn the screw.
Right. You need to learn the fundamentals of discipline, working hard, reviewing. There's you can't say enough about reviewing, and these chat rooms that you provide, I mean, are huge for people. That's how we learned.
Yeah, you remember we'd have the morning briefings and then review sessions, and then just desk to desk stuff, simple things that
Right.
could turn your week, your month, your year around, because someone said something that turned your focus, and um, now you were seeing more deer. And so you're out in the woods, and now you're seeing more deer because of something slight. You'll never get the opportunity of being able to switch to something right away and start making money unless you put yourself in a position where guys are looking at the right stuff to, you know, put yourself in a better predictive mode. And that's the right environment. I want to say this, and then I'll wrap it up. One other quick question, then I want to wrap it up with something. Do you ever look at gold at all? Relationship with dollars
Not
or
anymore.
treasuries?
No, not anymore. I don't look at oil. I don't look. When oil was breaking from 80 to 50, that was really important. But now that it's kind of settled in a range, I don't look at it
What was it
anymore.
doing to treasuries?
Oh, we would catch a bid.
Yeah, because the stocks get pulled down with all the oil stocks repricing. See,
It
go
was
ahead.
it was incredible how how good it was. I mean, it was literally 10-cent move down in oil, and the bond would catch a bid.
See, that's what's important. Where I was late to even seeing that. I seen oil affecting stocks. What's really cool about that's why volatility creates opportunity because relationships work better. When you get a reprice in oil over the course of a couple months, it went from 80, like Wojo said, broke about $30, $40. It was a reprice type of environment. And you'll get those days, weeks, and months. Well, volatility, everything is repricing, and it's repricing a lot. Back down, back up, based on a news event, based on a comment, based on a rumor, all that stuff. That's why
Yeah, the
opportunity
same
comes
thing
from
same
volatility.
thing happened in the currencies when the euro broke from 35 to 25 down to 20. Um, it destroyed the long end of the treasury curve. If you didn't, it was great. I mean, it literally went one for one, just like oil did, and the opposite effect for the price for the direction of bonds.
So
But
going forward,
it doesn't last.
right?
It like a firecracker. It's hot and heavy for about a week, and if you recognize it, you can hop on board and get after it. But don't expect it to last. And as soon as it doesn't last, I mean, you got to gear down from sixth gear to back down to second gear real
You can't keep
fast.
doing the same things without the same
No,
results.
it's not going to work.
You got to move back out of it. So leaving like
Right, just like this Greece stuff. I mean, if it's hot and heavy like yesterday, the next headline that says that they're going to default if they don't get their bailout, don't expect the same reaction.
yeah,
Old news.
especially if you don't get it. I mean, you could sell it and you don't get stocks to go. Get out. Don't be surprised. Let the other
Right,
guys
right.
get trapped. Um, it'll be interesting to see how this kind of just develops and if it does have legs to be a fear
I
factor.
don't think it has legs. I mean, I'm pretty in tune to this, and I think it's just kind of saber rattling out of Greece to say, give us our bailout, or we'll default. And they've even said, the Troika's even said, if they default, it doesn't mean an automatic exit.
What are you looking at now?
It'll be bad. I mean,
Right.
no doubt about it. It'll be volatile for a while. I hope it doesn't happen. It's bad for us. It's bad for treasuries. I'll say
For
that.
what? The possibility of Greece
Of a
exiting?
default.
Okay.
A, a, a Greece exit is really bad, but just a default will get us rocking and rolling for about a week, and then it'll just it'll be terrible after that.
Would you want to see him exit the EU as a trader of spreads?
No, I don't. Um, the short-term volatility, yeah, I'd love to see it, but I know in the long run it's bad for our business. Um,
It just dry up.
it dries up, right? It's hot and heavy, like I said. It gets really good. It might even last a month or
Yeah.
two because it'll be such a big event. But you got to take it in perspective of what it is and what the impact is on the market. Creates fear investing, and there's just a lot to. There's way more negatives than positives, and obviously we don't care what direction the markets go. We collect our pennies everywhere, but we want the volatility to maintain some kind of.
You want every day to, yeah,
consistency.
you want to, right. The more consistent movement is, the more consistent and groove you could get into as someone
For sure.
interacting with it. This is something that if you're trading S&Ps, what are you looking at now for the near term? Anything come to mind?
I haven't really looked at too many ancillaries, but I would definitely look at the sectors. I can't even think of what sectors you would look at right now because everything's kind of mundane. But if it's earnings season, I mean, look at the most important manufacturing. So you'd find whatever sector GE's in and all those companies. And then when the financial comes out, look at those FZRs or whatever that is. I can't even remember.
XLF.
Yeah, XLF, right.
Just
Yeah, you
just
want
to
to
see what's moving, and that's going to indicate what's influencing.
absolutely. It's going to have whatever's weighted in the S&P or the Dow or the Nasdaq. That's what you want to look at. Excuse me.
Well,
Yeah,
that's what I try to tell guys is to have and it's just an idea, have a correlation party, where and what, in more eyes on what we're supposed to be looking for. What do you see driving us? That's where the room has helped me, where a guy will say, hey, the DAX is leading, or led that move, or SPY gave a nice couple moves, kept me out of trouble last week. That actually had a couple where it skipped, and that's kind of like an ETF or a sector in a way. It's going to mirror the S&P and the minis, but the correlation, market correlation party is everybody brings their correlation to the party to see what's driving what, and if it's a short-term use, who cares? Because there's always something driving something.
right. You can find a trade anywhere.
Yeah, right. A driver, something to kick you in the trade. What I've been having trouble, a little bit better as of late, is buying the little pullback. I like buying the breakout. I like it to just run, even if it just runs a few ticks. I like to just get them anticipating buy stops above, or selling and anticipating sell stops below, or a breakout. But it's been tough for me to buy a little pullback, even though I know it's bullish. I miss the good ones and take the bad ones, take the ones that don't work. But that's
Yeah, I've been keying on pullbacks. Trying to find something I did last week. Was it last week?
in what market?
S&Ps.
See, this is a PNF only without the numbers in it. This is kind of what number is this? A 3
Yeah, $3.
on the 5-year? Oh no, the S&Ps.
Here we go. I think it was right here.
This
Oh yeah,
was this
even
overnight
mark.
or after our open?
This is 11 o'clock at night. Well, that doesn't make sense. No, it was in the morning. I don't know why this is showing at night, but I even have it marked right here on the prices, the two pink highlighted markers. 68 and a quarter is where I got out, when I should have been buying between 68 and a quarter down to 66 and a quarter. I got in too early. I started buying at 2070.
Off all these swing lows?
Yeah, and I should have been buying closer to, this price here, and I'm talking about the lows. You can see, where's my pen? This is a really nice chunk of price action right here. This is giving me a lot of nice support. So why, I bought too many. I think I had 30 or 40 on when I puked, and I did them really fast. I mean, like every tick I was buying, probably a 10 lot. So I was buying in through here, when that's when I should have started buying is right here. And I might not have bought any, but I would have had maybe a couple on. I probably would have had a 10 lot on versus, where I puked is where I should have started buying. And it's my own fault, and I really like that setup too.
I just thought that flashed in my head to say was what you just said. Someone in some I gotta end on this note, was in this retail forum they did this exercise. I don't know why I got into this. I'm not going to mention the thread, but the guy said something. It's a real retail. If you were to read it, you'd get goosebumps. It's just guys talking about things that are either irrelevant or, hey, look at me, I was right type of, banter. And the point I'm trying to make is they had, if you think sometimes if you're not trading well or reading it well, buy it where you would put your stop. So if you're going to buy it at 82 even and you're going to risk to 80, don't buy it at 82. Buy it at 80. Buy it where you would puke it.
I think I set my prices wrong, like in the DOM, and I really wasn't paying attention because I don't trade the S&Ps. I just like the setup. I saw this shelf, this whole thing here.
And this is overnight? What time was this?
This was in the morning sometime. This was probably
after the open?
The times that this was probably in the early morning, like around 6 a.m.
Okay.
or something like that.
See, that's cool. Buying consolidation off the low consolidation is even safer.
But this is where that black bar where I drew it is where I wanted to puke. So I puked here, and I wanted to puke here. So it's a complete mistake on my part.
I see what you're saying.
I caught it. I mean, it was a great trade. I just made a bad mistake, and
And it happens. See the difference between guys who do this and do it well are not afraid to talk about mistakes. You talk more about mistakes and losers than winners. That's the game. There's no guy that's trying to help other people who is insecure that'll talk about losers. They won't do it.
And then look over here. It worked out again. So you have multiple lows. You have 1, 2, 3, 4 lows where you never would have puked.
No, you're above where the stops were. Sell stops are below that black line. As long as it hangs above there, especially pre-market, buying the lows off consolidation is a little safer because you usually could hold it multiple attempts before the breakout. So
I'm surprised we're not a little higher considering this move here finally took out this stop over here. We're really consolidating in this area. I bet we go higher over the next few days.
It rallies, then chops, rallies, then chops, rallies, then chops.
Yeah.
Or sells off, and then everything goes back into a consolidation. And that's where I kind of tell people, if you don't catch it, you got to pretend like you did so you don't take that next trade in the chop. And
yeah, this was a pretty big resistance level right here, this R. This is old resistance. Now that we've gotten through here, in my opinion, this now becomes support.
Where's that, around 84?
Yeah.
We'll see. It'll be interesting to see how they close. Will you take the...
That's just how I look at, trading outrights. I do it a little
We do
bit
it the same. I use a PNF. It happens to be a 4. And with the footprint on Market Delta, you could actually see where guys are defending the lows, and not just in price, but where they come in and pick up the tempo, right? So when they come in, they crack it and quickly turn it. You'll see these greens show up, and you line them up and say, okay, this is where the bulls are nervous, below this point. Or a thin spot, we call it, where you know how tempo picks up and you could rally. Market rallies and there's little volume there because it fled through that area. Well, that's a great look at support, because that's where the guys missed buying it the first time. So they're trying to buy it the second time. It goes down, they don't get filled, and they rally from it. So the rotations on the you found the PNF around the same time I did, about 5 years ago, right? Is that when you started using
Yeah,
PNFs? Man,
sure.
I wish we
Yeah.
used them back 10, 15 years ago. It's the best look at a rotation.
You'd have made so many fewer trades, and you'd have been able to, like I said, the way I trade outrights is I know I'm not going to be right on my first entry. I hope on my last entry, you know, I should start to see a turn in the market, and I'll be comfortable with holding it. And as long as it doesn't violate a stop, you know, you can hold it for hours.
So you're scaling in, but you're disciplined to know where you're all out.
Yeah, I puked the whole thing. I mean, I don't know. I haven't discovered a right or wrong way of trading outrights. I'm just looking for the best opportunity to take risk.
Yeah, and have it go your way ASAP. I
Yeah,
mean, that's the definition, and I try to tell people of a good location. Have it go your way as soon as you can, because as soon as you buy something and take heat, you're questioning it. I don't care. I don't care how good and solid you are as a trader. As soon as you get long and it's going against you, yeah, you might want to buy more, but you just wish you wouldn't have to take the heat. Your mind starts maybe trying to play games with you. Um, it's always,
that's why even like when I started teaching guys trading outrights, you had to at least have a, you know, a 2 lot or a 3 lot, so that if you don't want to buy all three at one particular price, you want to buy it in a good area. Define your area and define, you know, your add-ons, and then define your loss price.
you know what, that's what maybe I'll incorporate with, I'm good at breakouts. There's nothing I'm going to do different with momentum. It's the pullbacks. I like the area, not the price. Like the area, not the price. And it's
Yeah.
not adding to,
I don't even know what price is. I wish I could just call this order into a broker.
yeah, you're trading the bias.
Yeah, that's why PNF runs are so good. I just look at, I just wait for that setup to happen. I mean, this is a long time in between this span here and this span here where I never made a trade. I missed this one. I missed this one. But
No, right. There's just trade the area and not the price. You won't be sensitive. Don't be so damn sensitive on buying a pullback. You're not wrong until X. And as long as X hasn't gotten elected, you're in good shape. Multiple contracts also give people the ability to get out of taking some profit too, without feeling so like it's all about trading is all about preventing, uh, minimizing getting mad. So if you're long 3 contracts and you got some money into it, will you be mad if it goes back to your entry? Yes. Will you be mad if you get out of everything and it rallies another 10 points? Yes. So how could you do? Take some off. So if it goes down, you're not mad you took profits. If it goes up, you're not mad because you still got something on. That's the logic that allows people to not puke too early and never go broke taking profits. And that's the key, is to have the flexibility. It's not easy to go from 1 to 2, Woj, and you gotta remember, and I never thought of it that way, but for people who just trade 1 lots, when you trade 2, you double your risk. There's no way around it.
yeah, it's 100% risk, increasing your risk.
There's nothing you could do, but once you get decent, not great or good, but decent at trading, it's just numbers. They just become numbers. Yeah, you feel extra risk if you try to put too many on, but if you just, one thing I say is when you buy a 1 lot, you're on the team. When you buy a 2 lot, you're on the field. And you got so much more control over your thought process and trading. You got to learn to trade, and It has nothing. Trading is trading. I want them. I don't. Give them to me. Give me more. I don't want these. Why did I get out? I should have kept them. Trade, trade, trade. Pick your prices. Pick your where you're wrong. Where the hell are other people wrong? You don't realize it, Woj, and I learned this just by talking through it and teaching guys, and maybe you do realize it, but we were always good at knowing where other people were stuck, you know, without
Yeah.
having that articulated back to us. We knew where people were going to get. That's why it ran. People were stuck short, and the bonds yanked the boon up, and the stock sold off, and was everybody being wrong the other way, you know? So, no, that's good. One thing I'll leave you with, Woj, and you'll find this funny. So I get an email from someone that is, I don't know, won't say the name of the company. So I go in, I just click it, and it brings me into this like forum. It's like a room, right? It's like a free room, and they do um, I guess they had some contest that said, guess where the NASDAQ is going to be in a half hour? And I'm thinking, well, what kind of, if you want to, if you're doing this for entertainment, show someone juggling or showing or telling jokes. That's entertainment. But instead, just where the NASDAQ is, what comes of that? Are you better if you guess it right? How about this? Tell me where it's going to be in a half hour and where you would get long and short or short. And
Right. Define why it's going to be there and how it's going to get there.
right. That's the contest, not just where it is. Oh, look who won. Great job. How did you know that? And then everybody wants to know how the guy knows it. It's a guess, you know? It's a guess.
Right.
And it was comical. But Woj, I appreciate it. And everybody that has left has said thanks because conversations like these and listening to you and listening to us, there's always something you pull out of it. And I'm set working harder on ancillaries, whether they're these ETF sector ETFs. But anything you see, like you kind of been doing, just text me and we'll keep doing these maybe once a month, but we appreciate you coming in.
Yeah, not a problem. I'm happy to do it.
All right, buddy. Thanks again, and I'll
All right,
I'll
guys.
stay in touch.
Take it easy. Good luck.
Thanks. Let me take the screen back here, guys. Hold on a second. Yeah, so I'm still recording. We're going to have him back. We're doing once a month. We've been able to do that so far. Um, but it's from like time to month to month, what's changed and what's different. I think the biggest takeaway is what are you watching and when does that change? And that's where group help is the best. I can't underscore that enough. The other thing was we know it's an asset bubble, but people have no other choice but to put their money in equities because bonds, they go up on fear, and the more they go up, the less attractive they are. So therefore, they still have to go into equities as a reach for yield is the phrase he used, searching for yield. If you can't find it in treasuries because they're almost 0%, you either put it in your mattress or you buy stocks and might as well take some risk. And these are the hundreds of billions of dollars in funds and capital that has to go somewhere. But capital preservation, you still make money. Like he said, he just had to increase his size so that the little bit of profit that the market was giving him was enough to say, I'm out. So let's say he only had 50 spreads on and it'd only move a half a tick. Well, maybe that's $500 and that plays a role where I'm going to take $500 out. I got to triple this to make it worth my while. And so that's where you increase your size because the market just isn't giving you those 3 or 4 tick winners in the 10-year or in that particular spread. So by increasing his size, now a half a tick or a 1 tick winner was worth it. And the risk didn't really change. The number changed as far as the size he was putting on. But now he's able to take it. See the difference? Take a small profit, which isn't a small profit anymore, instead of scratching it or taking a small loser. That's the difference. Now you could accumulate while you preserve, but what he said being counterintuitive would be increase your size when it's slow. Well, that's when you do it. You decrease it when it's faster and more volatile because you're going to take more risk and more reward. And then you try to slowly increase it when it's slow so you could stomach these smaller profits and not worry about getting knocked out too soon or turning a small winner into a scratch or small loser and it accumulates the wrong way. That's pretty much it. If you guys got questions to wrap it up, I'll stick around. Next week we have Dr. Kepler coming in to do just an edge-only event on the Delta Accord, and I think that could highlight better profile levels. He's not going to teach about profile. He's going to teach how to execute at different profile levels, and that's, I think, it'll be a good one. That's next Tuesday. We're going to go back to 11 o'clock start times. When Woj comes on, it'll be 1:30, but you guys will have that email to remind you of that. And then the week after next, we'll try to do another trader spotlight because we got good feedback from Brad's interview. We'll get someone else in there. I think it's huge to hear how other people are doing, even if they're not doing well. It's not just the successful guys, but the guys that are struggling or guys that are making money and came from never being able to figure this out. That's what's important. So I'm trying to schedule that for 2 weeks out. Anyone want to volunteer for that, let me know. And that's a good time for a spotlight class. I've had some clips that have been cut that I want you guys to look at. Keep reviewing those clips, and just to remind you that review of seeing the instances and writing them down yourself is great review. So the learning was, what do these instances look like? And that's what the clips are for. That's what these classes are for. But the review and the exercise coming out of that is, hey, I seen it. And you write down as many times as you see it during the course of a session or a week. It's how you're going to build confidence, and it's going to come to you. And it's going to become a reaction. And how it kind of gets soaked in a little bit. Transitional moments. The class we did last week. Write down the times you think the market's transitioning in real time. It'll be much easier to execute. I read it better than I traded it. A couple good transitional moments off the highs today and then off the lows. I think twice we had rejection. Again, for those watching on a recording, it's April 14th. In the S&Ps today, we went down to 75 quarter, rejected, ran up 7 points, came back, and I think the low was like 76, 77, and another transitional moment where it was just a turn, and the upside became the right side the rest of the morning. But those in the room, we'll see you tomorrow. Those that are not, we'll see you next Tuesday for Kepler. That's the 21st. Just so you know, 11 o'clock Central will start at that time. Give me a day, but for sure I'll have this recorded posted. And we'll have Wojo on in a few weeks and keep doing sessions like this to see how things have changed. Have a safe night and week, guys. We'll see you tomorrow or next week.